Hey everybody, it's Michael Houston. I'm the Chief Investment Officer and co-founder of Heirloom Wealth Management. I'm here solo today, so I'm going to use this as an opportunity to get a little bit nerdy and talk about our macroeconomic framework for investing. And while that might sound nerdy, using this approach that I'm about to walk through has delivered outstanding results. I'm going to highlight our balance strategy, which ranks in the top 1% for all investments in the category over the last 9.5 years, and just show you, the results that this has delivered. I'm very excited about that. So, without further ado, let's jump into the framework. So, when you think about what's going to drive asset prices into the future, it's really two major forces: economic growth and inflation. Mike, if you could throw up the slide that we got there, that'd be great. So, on the top side of the slide, we're looking at rising economic growth, falling economic growth on the downside, and then low inflationary and high inflationary environments on the x-axis. Now, if you look at this, you can easily break this into quadrants. For instance, in the top left, we're seeing inflation's above the median and inflation's below the median, GDP is above, right? Great environment for stocks. Stocks love that environment. On the bottom left, inflation is below the median and GDP is below the median. That's great for bonds. And that's good for most investors. That's been an environment that we've seen commonly over the last 20 years. But if you look at the right side, we're seeing higher inflation. Traditional stock and bond portfolios did not perform very well in that environment. And so one big differentiator for us is we incorporate an additional asset category to stocks and bonds called alternative assets. And that's delivered uncorrelated returns. So Mike, if you want to throw up our asset category pie chart, when we look at our benchmark, and for this strategy, is 40% in equities, 60% in stocks. So we keep the equity portion the same, but for the 60% in stocks, we carve off half of that and place it in alternative investments. Now that does a couple things for us. Introduces new forms of return that are not available in correlation to what stocks and bonds do. And that helps us to increase our potential return for the portfolio, but also decrease risk. And we're going to show you the numbers to back that up. So if you want to throw up the risk numbers that we have here, and this is, we pulled this from Morningstar, and this looks at the heirloom balance strategy, net of all investment expenses and advisory fees, dates back 9.5 years. So from beginning of 2016 through the second quarter of this year. I'm really excited because third quarter has been very good for this strategy. These numbers are going to get even better. But really when you think about what you want your portfolio to do, more upside, less downside, great taste, less filling. You remember those old Miller Lite commercials? That's what this strategy has delivered. And that is really quantified best in alpha, which is north of 5 times greater than the Vanguard Wellesley Income Fund. That's the fund that Morningstar says, hey, this is the best in category. Well, maybe not. I think they should take a closer look at that because Heirloom Balance has absolutely crushed it. So, with that said, let's look at the numbers because it's great to talk about percentages and ratios, and I'm a big nerd, so sometimes I dwell on that too much. But when you really step back and think about what that's delivered for our clients, it's more money. Okay, so for $1 million invested in Vanguard on January 1st of 2016, the Wellesley Income Fund, through June 31st of 2025, you would have grown to 1.73 million. With the Heirloom Balance strategy, you'd have 1.961 million. That's an extra $231,000 that you would have with Heirloom versus investing with Vanguard. That's after investment expenses, after advisory fees. I attribute much of that to this framework that we use for macro investing, incorporating alternative return sources to perform better in times of higher inflation. And really, what that does is give our clients a smoother ride, more money. It's a win-win. So hopefully I didn't bore you too much today. It's good getting a chance to talk with you. Thanks for joining me.